All right, let's get right into it. Today, we are tearing into the exact mechanisms of structuring a remote US business. We're going to process a fascinating, specialized expert report that completely strips away the fluff and generic advice you usually hear online. We are treating this as an anonymous expert deep dive, focusing strictly on hard data, actionable insights, and the hidden, implicit assumptions of setting up a remote entity in the United States as a non-resident. Listen, getting this wrong doesn't just mean a failed business. It means severe financial penalties. So let's look at the actual data and figure out how this machine really works. Okay, let's dive into this. Here is our roadmap for today's explainer. We're going to start by breaking down the remote US infrastructure, then move into a hard, data-driven structural comparison between Delaware and Wyoming. After that, we'll untangle what's known as the non-resident tax paradox, completely deconstruct the nightmare that is US sales tax, and expose the hidden costs of mandatory reporting. Finally, we'll synthesize the whole thing into a high-level strategic playbook for founders. So, Section 1, the remote US infrastructure. Before we get into the weeds, we absolutely have to establish the baseline reality of what it mechanically means to bridge a foreign operation into the US market. To kick things off, we need to define the core mechanism we're dealing with here, the non-resident LLC. Expert analysis defines this as a highly specific legal entity that grants you access to the US financial infrastructure, all without requiring a visa, citizenship, or any physical presence whatsoever in the United States. And I really want to highlight that phrase, without requiring a visa. This is a huge implicit assumption where foreign founders get completely jammed up. They just assume they need complex immigration paperwork to participate in the US economy. They absolutely do not. You have to think of this structure not just as a company, but as a gateway. For international founders, it's a direct, frictionless bridge to US banking, payment processors like Stripe or PayPal, and global financial credibility. It operates 100% remotely. Now, you might be wondering, who is this actually built for? Well, this infrastructure is specifically engineered to democratize company formation for digital-first, asset-light businesses. The optimal models are e-commerce operations, SaaS platforms, remote consulting services, and independent digital freelancers. Barring a handful of federally restricted jurisdictions, this framework allows these specific types of remote operations to plant a flag in the world's largest consumer market. You don't need a physical warehouse, you don't need to sign a brutal commercial lease, and you definitely don't need an office space. You just need access to the financial ecosystem to scale your operation globally. Moving right along to Section 2, structural comparison, Delaware versus Wyoming. We know the why at this point, but now we need to look analytically at the where. And this brilliantly illustrates why setting up a company is never a one-size-fits-all scenario. You've probably heard of Delaware. It's universally recognized as the absolute industry standard for venture-backed entities. If your long-term roadmap involves issuing equity to your employees, building a formal board of directors, or raising venture capital from institutional investors, Delaware is mechanically built from the ground up for that exact purpose. Wyoming, on the flip side, functions very differently. It's a high-efficiency, low-cost engine. It is heavily optimized for privacy and remote e-commerce. It's basically the lean, mean cash flow machine of the LLC world, designed specifically to minimize your overhead while keeping your operational agility maxed out. When we dig into the hard data and isolate the operational costs, a very clear cause and effect relationship emerges based on which state you pick. Sure, both states have roughly the same costs for a registered agent and a basic mailing service, but the real divergence is in the annual state fee. Delaware carries a flat $300 franchise tax liability every single year. And get this, that's regardless of whether your business makes a single dollar in revenue. Wyoming's reporting fee, however, is remarkably cost-effective, roughly $50. If you're bootstrapping a startup from your laptop, that $250 difference isn't just a fee. That's critical operational capital you are bleeding out for absolutely zero structural benefit. So mechanically, how does this actually come together? The operational flow of formation is shockingly streamlined. You just detail your entity and state selection,
distribute the shareholding percentages among your founders, remit the initial formation payment, and then digitally sign the automatically issued state documents. Because you're using the proxy structure of a registered agent, this entire process takes mere days, and in states like Wyoming, it can keep your ownership completely confidential. It's a totally frictionless deployment of a legal entity, entirely bypassing the massive red tape of traditional embassy paperwork.
Let's transition to Section 3, the non-resident tax paradox. Pay close attention here, because this is the single most crucial analytical pivot of our explainer today. We are going to untangle the insanely complex web of US taxation for foreign owners. I want to pose this question directly to you to see where your head is at. Does incorporating a US LLC automatically mean you have to pay local US income taxes? Well, the implicit assumption for almost everyone is that a US company inherently equals US taxes. But analytically, that assumption is fundamentally flawed. Let's break down this piece of expert insight. The report notes that if you don't have effectively connected income or live in the United States, typically that's not going to generate any kind of tax payment. So, what does effectively connected income actually mean? It means US income tax is tied directly to physical operations and local nexus. Local nexus is just a fancy way of saying you have boots on the ground. An office, a physical warehouse, or a W-2 employee physically sitting within the United States. Tax is not tied merely to the state where you filed your incorporation papers. Remember, an LLC is a pass-through entity. The tax burden literally passes through the company and down to the owner. So if the owner is a non-resident and there are no physical operations in the US, there's technically no effectively connected income.
So the crucial point is this. Without local operations, the US can functionally serve as a tax haven for non-resident business owners. By intentionally keeping your physical operations, your servers, and your employees outside of US borders, you effectively shield the entity from US federal and state income taxes. Now, your tax liability defaults to your local country of residence, so definitely ensure you are compliant back home while you optimize abroad. The whole strategy here is isolation, strictly separating your legal framework from your operational reality. But hey, before we start celebrating a zero tax victory, we immediately need to look at Section 4, deconstructing US sales tax. If you conflate income tax with sales tax, you are going to fall into a catastrophic compliance trap. We have to emphasize the distinct cause and effect relationship at play here. We need to separate the two most wildly conflated tax concepts in international business. Income tax, as we just discussed, is based on where the company operates and where its owners live. Sales tax, on the other hand, is based strictly and entirely on the physical location of your end customer. The driver here is consumption, not where your corporate entity exists. Let's look at the harsh realities of US sales tax. It is triggered by economic nexus, which means it's triggered by where your customer sits when they buy your product. And importantly, this applies to both physical goods and digital goods or services. Let's walk through a real-world example to lock this in. Say you have an LLC in Delaware. Delaware has a 0% sales tax, right? Sounds great. But if you sell a digital course to a customer sitting in California, you immediately create local tax exposure in California. You are legally required to collect and remit California sales tax because they have some of the strictest economic nexus thresholds in the country. Your Delaware LLC does absolutely nothing to protect you from California's tax laws. And believe me, California's tax authorities are not exactly known for being forgiving. All right, now we are fully entering the danger zone. Section 5, mandatory reporting and hidden costs. This is where implicit assumptions lead straight to severe financial and legal penalties. I need to slow down here and deliver this as a stark, glaring warning based on the expert data. Zero tax liability absolutely does not equal zero reporting requirements. The most massive mistake foreign founders make is assuming that because they don't actually owe any income tax, they don't need to talk to the IRS at all. But think about it analytically for a second.
The US government is not going to simply allow hundreds of thousands of foreign-owned LLCs to just exist inside their financial system without an ironclad paper trail. No way. Let's move on and see how this builds into a rigid, mandatory timeline of compliance. And keep in mind, this timeline exists entirely independent of business revenue. In Q1, you have to compile all your financial transaction records. By mid-April, you must file your federal informational returns, specifically Form 5472 and a Pro Forma 1120 for single-member LLCs. Then, on an annual basis, you must remit your state franchise or reporting fees and renew your registered agent services. This is a mandatory operational rhythm that you literally cannot ignore. And here is the totally non-obvious logistical nightmare of international compliance. Foreign owners generally lack US Social Security numbers, or ITINs. Because of that, you often cannot use consumer-fast e-filing software. Instead, critical documents like Form 5472 frequently require physical snail mailing to the IRS or filing via highly specialized tax professionals. This means an April 15th deadline actually requires weeks of advanced preparation just to account for global transit times. On top of that, there are hidden administrative steps most people don't know about, like filing a BEA 13 exemption notification with the Bureau of Economic Analysis. It's a lot to manage. Now, what's really terrifying about the data is the financial penalty for getting this wrong. Expert analysis shows that the cost of ignoring compliance or trying to fix a botched tax structure retroactively is anywhere from 3 to 10 times the cost of simply doing it right the first time. The IRS imposes incredibly harsh flat rate penalties for failing to file a Form 5472. We are talking about the IRS hitting you with a $25,000 fine for missing a single informational form. And yes, that applies even if your company didn't make a single penny in profit. Ignorance of the law is not a recognized offense here. Finally, let's bring this explainer home with Section 6, Strategic Insights for Founders. We've gone through the hard data and the hidden risks. Now let's synthesize it all into an actionable top-level strategy. Think of this as the expert playbook, summarizing our core thesis today. First, optimize your state selection analytically. Choose Delaware if you plan to issue future equity or raise capital. Choose Wyoming if you want to optimize for immediate cash flow and privacy. Second, strictly isolate your income tax strategy from your sales tax reality. Remember, where your company lives dictates your income tax, but where your customer sits dictates your sales tax. Third, bake those annual franchise fees and registered agent costs into your baseline operating budget right from day one. And lastly, treat federal informational returns as absolutely mandatory, never optional. Structural efficiency requires rigorous, relentless adherence to the rules. I'll leave you with this provocative thought to chew on. You've successfully accessed the US financial infrastructure, but is your compliance strategy robust enough to survive an international audit? Please don't let implicit assumptions ruin your structural advantage. Double-check your legal frameworks and make absolutely sure your paperwork is as tight as your business model. Thank you so much for joining me for this explainer. Keep learning, stay analytical, and I'll see you next time.